Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Chan, you're watching Indian Open. Let's go straight to the headlines. US revokes India's designation as a developing nation, impacting exports of nearly 2,000 products, which did not attract any duty in the world's largest economy. Back home, India's GDP growth falls to a 20-quarter low in the first 3 months of 2019. The NSSO jobs survey shows unemployment at its highest levels since the 1970s for the period of 2017-18. And Finance Minister Nirmala Sitharaman will have to address these issues when she presents her maiden budget on July 5th. The date is out. Well, let's take a look at the trade setup for the day. The world is not looking a very happy place because the trade issues have now spread. So China has threatened a sweeping blacklist of firms after the Huawei ban from the US side. So China, it is a very big week, a very important weekend as well. And if indeed this one snowballs into something bigger, then we're actually seeing at a much heightened version of a trade war than earlier believed. Remember, the belief was that whatever we're seeing, it will all cool off. The last couple of weeks have been evidence to the contrary, and it is only snowballing into something else. Now remember, Donald Trump had already threatened tariffs on Mexico or surge of immigrants. There was some bit of to and fro when it comes to the EU and the US as well. And Donald Trump has gone ahead and terminated India's designation as a developing nation. So, all of that really leading to heightened fears of trade war. And, the latest salvos from both the sides seem to suggest that there is no detente in sight right now. It is just looking like the hostility is only going to go higher. Now, what did all of this do to the US markets? Remember, the US markets got impacted in part because of Trump's comments on Mexico earlier on in Friday. So they corrected about 1.2 or 1.3% apiece in Friday's session. And the month of May as well, for the US markets in particular, you could argue hasn't been as good as what some of the other months have been. So they've fallen amidst the trade tensions. India has done okay because of idiosyncratic factors, but the US markets have certainly been disappointed because of what's happening across the world in terms of the trade tensions. Well, back home too, the cues aren't the most optimistic, you would have to say, because if you look at the economic data that is coming out, it's not looking all that great. The unemployment rate of 6.1% for the period of 2017-18 is the highest since the 70s. The Q4 GDP growth numbers at 5.8 at a 20-quarter low, and the high frequency indicators, which is the auto sales, are now starting to show some pressure. So the likes of Maruti, Tata Motors and Eicher Motors, all of them came out with numbers, one the most great, and the last 1 week, all of these stocks have largely been on the losing side. There are hopes pinned though on stimulus. The announcements that came in post-market hours on Friday from the government, the PM Kisan scheme is looked upon as a stimulus for demand revival. GST collections have crossed the 1 lakh crore mark in April, and this is the 1 lakh crore mark for a third straight month, which is a pretty heartening thing. And arguably, one of the most important things for the Indian markets, from a market sentiment perspective, is crude, which has continued to go down. And if you look at the month of May, it's been the worst May in the last 7 years. And the last 2 or 3 days, and especially Friday's session, was particularly brutal for crude. So came down all the way to 61 and 53 for NYMEX and Brent respectively. Let's wait and watch what happens during the course of the day today. What will one watch out for? Well, 2 or 3 things. Firstly, the bond market rally across the world, and if that continues, then the world markets may remain under pressure, so you've got to keep that in mind. And what does that do to our yields as well? 7.03 is where we have shut shop. Remember, most experts have said that India doesn't tend to sustain below the 7 mark for too long, so it'll be very interesting to see what happens here or to the yields individually. And therefore, because of this, what happens to the MPC's decision? Because I think, to my mind, that is arguably the most important event to watch out for this week, maybe this month as well. So do watch out for this. Amidst all of this, what are the stocks that one should watch out for? Well, it's largely looking like autos. So let's wait and watch what happens. Firstly, Maruti, the sales have fallen for the third straight month, the biggest fall since 2012. So let's see if there is some more pain in store for Maruti. Should start off lower, but keep in mind, last week has been brutal for Maruti. Any which ways, it's come off quite a bit. So let's wait and watch if there is further pain in store. M&M too, the tractor sales slowdown for M&M and Escorts. So M&M tractor sales were down 16%, Escorts sales were down about 18%. So these are the couple of names that I would watch out for. Not quite sure of what to do with the IT pack, to be honest, because while it has this defensive bent, and the belief is that the rupee depreciation may aid, but because of the crude uptick, we might well see the rupee moving up higher. So it'll be very interesting to see what happens to IT in the session today. And then, of course, watch out for ICICI Prudential. There was some news flow from, I think, one of the media houses about a very large global investor looking to buy stake in ICICI Prudential. Let's wait and watch if that were to happen. However, let's tell you what's lined up on First Word today. The top editorial stories. Donald Trump's been busy all through this weekend, first revoking India's developing nation status and then taking on a more aggressive China. Is it only going to get intense from here? Trade expert and Bloomberg Quint columnist Raj Bhala joins in with his views. As India's GDP growth falters, Pallavi lists out the specific pressure points in the economy, and the pain could not be more pronounced for Indian automakers. Yatin takes us to the monthly sales numbers. US President Donald Trump opened another potential front in his trade war on Friday. His administration terminated India's designation as a developing nation. This means India would no longer be exempted from duties in exporting nearly 2,000 products to the US. Trump said, and I quote, that India has not assured the United States that it will provide equitable and reasonable access to its markets, and hence it was appropriate to terminate India's preferential treatment with effect from the 5th of June. India, of course, responded by saying that it was unfortunate that the US did not accept a resolution it has offered during the bilateral trade talks, but maintained that its trade discussions would be guided by its own development imperatives and concerns. What does this mean for the relationship between the two countries? To discuss that, we're joined by Raj Bhala. He's, of course, a Bloomberg Quint columnist, distinguished professor at Kansas University School of Law as well. Professor Bhala, thanks so much for taking the time out, and good evening to you. I think. Good evening to you. Yeah, no, I was just going. I was going to ask you, from what little I've read over the weekend, it doesn't seem to be too big a dampener because the quantum of goods and therefore the duty benefits available weren't that big, and maybe some export incentives will do the trick. But what does this signal in way of relations between India and US?
Yeah, you're absolutely right. The total trade value of GSP covered goods was about $5.7 billion in 2017. But the actual trade savings in terms of tariffs was only about $260 million. And indeed, the margin of preference, that is the difference between the average US MFN tariff and the zero duty under GSP, is quite small. And it's sometimes said that really GSP is an asset of diminishing value because of that small margin of preference. And I don't think a great nation like India was staking its future on forever, if I may say, milking the cow of the GSP. I'm smiling because I think this is one of the greatest opportunities that India has since its independence to distinguish itself from China and also to develop the strongest relationships with the United States that it has had since independence. And let me explain why. First of all, India's got some sectors that can really benefit from the Sino-American trade war. In an excellent October 2018 paper by the Indian Institute of Foreign Trade in Kolkata, the authors very cleverly identified the merchandise that is subject to the Section 301 tariffs that are coming out of China, and compared them to the Make in India merchandise that are, of course, not subject to those tariffs, and identified several key sectors, including, for example, iron and steel, aluminum, electrical machinery, railway and locomotives, aircraft, spacecraft, many areas in which India could prosper and benefit from the now 25% tariffs that have taken effect on Chinese goods. And then we all know the story also that Apple and Samsung will be making more smartphones in India and exporting them to the U.S., whereas if Wave 4 tariffs go on against Chinese products, and I suspect they will sometime in the next few months, India will benefit from the smartphone exports to the U.S. But I think there's another piece of this too, where India can really distinguish itself. And again, this is the optimistic story, and that is India's willingness as a democracy to understand and accept its own shortcomings. Look at on the one hand, at the rhetoric coming from the Chinese, the People's Liberation Army leaders this weekend in the Shangri-La in Singapore, compared to the rhetoric coming out of the new Indian government. India appreciates that it has higher MFN duties. It's got a market access problem. For example, its overall average tariff rate's about 13%, whereas the U.S. is 3.4%. That's something India can work on. India knows it needs more FTAs. India knows it can join in some sectoral agreements. But in contrast, the U.S. relationship with China is much more fraught with denial, and the U.S. would sometimes say deception from the Chinese side. I think this is just a great opportunity, substantively and stylistically, for India, again, to really show it is different.
So, Professor Bhala, I'm presuming you are sanguine about what's happened on Friday from the US side. It will not have a big impact. But the other thing is, what happens in the event of what is looking like a slowing GDP worldwide because of what the yields across the world are indicating? And if this trade war and the shape that it is taking with Donald Trump, I mean, the US-China issue is one thing, but Trump's comment on Mexico, they're refusing to meet eye to eye with the EU as well. If all of this brings down the world growth numbers, and what does a country like India or some of the other EMs do in such a scenario?
Well, I think take each one of those separately. I don't think that the U.S. is in the end, or at least anytime soon, going to impose tariffs on Mexican merchandise. Already, the U.S. agricultural and chamber community and the Chamber of Commerce have come out very strongly against such a move. Probably what you'll see the U.S. do is kick the can down the road. And what I mean by that is, just as what the U.S. did with Europe and Japan on autos and auto parts under Section 232. Namely, the U.S. said, well, we will wait 6 more months before thinking about imposing tariffs because we feel there is sufficient progress being made in the bilateral Euro-American and Japanese-American trade negotiations. The U.S. is very likely to do that with the negotiations with Mexico. Mexico is going to be doing enough that the U.S. can say, well, we think there's enough progress here that we don't need to impose those tariffs. And of course, again, if it did, the pressure against it from the business and the farming community is enormous. Moreover, it would defeat the very campaign promise that the president would like to make. That is, I not only renegotiated a better NAFTA deal, but I got it through Congress.
Okay, so Professor Bhala, do you reckon in any sort that the world growth, which is already looking weak, whether or not the Mexico event happens or no is one thing altogether, and let's work with the presumption that the US won't do it, but the world growth, which is starting to look a bit anemic, would get pounded even more if the US-China issues do not see a resolution in the near term? It may not worsen too much from here, but it will not see a resolution.
Yeah, the forecast that I've seen that we probably all looked at in terms of a slowing of growth in China, 1.5, 1.6% GDP, a slowing of growth in the U.S. half or 0.6%, would have some knock-on effects. I don't want to minimize those, just like I don't want to minimize the tariff revenues that GSP producer exporters or importers have to pay when they lose GSP status. Every dollar matters. That's for sure. But I not being a professional econometric forecaster, what I have read is that even if we go to the full-blown wave 4 tariffs, the concern is, yes, a slowdown. How deep and how long that would be, that I can't say. But again, what India could plan for that worst case scenario of a significant slowdown by taking advantage of the opportunities it has through its a budding bilateral relationship with the U.S. But I'm sorry, I can't specifically tell you it's going to be 10% fall or 20% fall.
Okay, one last question, Professor Bhala. Do you think that post this salvo from the U.S., could the tariffs between, or tariff or any kind of relationship between the U.S. and India take a turn for the worse? Not a relationship perspective, but more a rate or a tariffs perspective. Can there be more products that would, on which some preferential treatments could be withdrawn from the U.S. side?
Well, the GSP list is pretty much the list that India's been enjoying, those roughly 1,900 articles of merchandise. I mean, the U.S. could impose soft, non-tariff measures, additional inspections. We've seen that with the Food and Drug Administration and generic exports in years past. But in terms of straight tariffs, unless the U.S. were willing to violate its GATT Article 2 tariff binding commitments, levying higher tariffs on existing products from India outside of the loss of GSP, no, I don't see that.
Okay, Professor Bhala, we'll leave it at that. Thanks so much for taking the time out and speaking to us. You have a good evening.
Thank you, you too.
All right, that's Professor Bhala with his thoughts. Well, as I think most people have stated as well, but it is good to hear from somebody who tracks this very closely. This withdrawal of the developing nation status and preferential treatment to $6 billion worth of goods is not a really big thing from an India perspective, and it probably doesn't signal worsening of relationships as well. As I heard Professor Bhala said, it's probably budding of ties between the two countries. So, well, let's wait and watch what happens. Will the markets take it too negatively? I doubt. The SGX Nifty is anyway showing a sign of positive start, so it doesn't look like that the Indian markets are taking it too badly. Anyways, let's move on to the next piece. India's economic slowdown worsens as GDP growth in the January to March quarter falls to the lowest in 5 years. This is mainly owing to weaker consumption and investment, coupled with slower growth in some crucial employment-generating sectors. Pallavi Nahata reports.
GDP growth in Q4 fell to a 20-quarter low as consumption and investment in the economy weakened. GDP rose by 5.8% in the fourth quarter of FY19, pulling down growth for the full financial year to 6.8%, according to data released by the Central Statistics Office on Friday. In gross value-added terms, the economy grew at 5.7% in Q4, with full-year growth at 6.6%. A Bloomberg poll of 43 economists had estimated Q4 GDP growth at 6.3%. Economic growth was estimated at 6.9% for FY19, according to 23 economists polled. So where is the slowdown? High-frequency indicators such as car sales and imports have suggested that consumption in the economy is slackening. However, the Q4 GDP data suggests a moderation in consumption demand, but an even sharper fall in investment in the fourth quarter. Investments, as reflected by cross-fixed capital formation, grew at 3.6% in Q4 compared to 10.6% in Q3. Private final consumption expenditure grew 7.2% in Q4 compared to 8.4% in the previous quarter. Government expenditure grew 13.4% in Q4 compared to 6.5% in Q3. Sector-wise, agriculture grew at minus 0.1% in Q4 compared to 2.7% in Q3. Manufacturing grew at 3.1% compared to 6.7% in Q3. Financial services, which many believed would be hurt because of slower growth in credit from non-bank lenders, held up well in the fourth quarter. Financial services grew at 9.5% compared to 7.3% in quarter 3.
Well, this GDP data then leads to 3 or 4 key questions that I think need to be answered in the near term. One, whether services alone can lead the revival in absence of agri or industry growth. So that's one big question, because hitherto it's been services, financial or otherwise, which are leading the growth for the Indian economy. Two, can GDP growth get back to the 7% plus mark in the event of an imminent global slowdown, which certainly seems to be the case? Therefore, post this 5.8 number, yes, the things can bounce back. Can we move back to 7% plus? That's the other big question. 3, will the GDP data that has come out thus far prompt the MPC for substantial rate action? I think everybody's pricing in somewhere between 25 and 50 basis points. Can it be substantial? Can it be 50? Can it be 50 with a dovish commentary? Can it be midway between 25 and 50 but with a very dovish commentary? That's the question that markets will be watching out for when the MPC meets this Thursday. Arguably the most important question in the near term. But lastly, will global money continue to float to the Indian shores if the world growth looks anemic? Typically, in cases of a global slowdown, money doesn't go out that much. It sticks to the safe haven assets. Will India be a beneficiary if it manages to show growth? That's the other key question. And will global money managers raise an eyebrow because the growth has fallen to sub 6%? That's the other big question. Well, lots riding on the autos, to be honest, when it comes to all of this, at least in terms of high frequency indicators, and lots sliding in the month of June for the Indian automakers because the monthly sales refused to budge from the negative territory. Almost all the players said consumers were waiting for elections to get over before buying new vehicles. Yatin Mota is here with more of that. Yatin, there's a lot of ground to make for the Indian automakers.
Clearly, Neeraj, and the numbers which have come so far seem to be slightly lower than the street expectations. And more importantly, if you look at the reasons, the election thing, ahead of the monsoon, seasonality, credit crunch, the whole host of reasons which the dealers as well as automakers tell us. Of course, May was expected to be slow, but it's much slower than what was expected. Starting with Maruti Suzuki. And 4 months in a row for 2019, we have seen growth declining. In fact, if you look at the percentage fall, it has been the highest in 2019. So clearly, if you look at Maruti Suzuki, the numbers were quite weak. In fact, if you look at the mini compact segment, where the pressure continues to be higher, has seen a 25% decline. And of course, if you look at the overall domestic numbers, ex-exports, we are looking at another 25% decline, which has come in. Similar is the case with Mahindra & Mahindra. Not only the tractor segment declined, we also had the automotive segment, which has also seen flattish growth. Tractor sales were down 16% for M&M at 24,704 units. Auto sales for the major was nearly 45,000 odd units. Of course, this is despite the fact that the Marazzo and the XUV 300 has been doing well in the marketplace. So on an overall basis, those new models are also not been able to contribute to growth for M&M. As far as truck makers are concerned, Ashok Leyland, of course, will come out with the numbers. Tata Motors came out with numbers. The total domestic sales were down 26%. Commercial vehicle sales were down 20%. And look at the fall in medium and heavy commercial vehicles. That fall is 38%, along with domestic passenger vehicle segment, which has fallen at 38%. And it's not that Tata Motors has a very large base last year. Of course, there was strong growth in the commercial vehicle segment, but clearly M&HCV as well as domestic passenger vehicle sales 38% down is clearly not a good number to watch out for. Escorts, again, something like M&M, 18% decline is what we saw there. SML Isuzu 17% down, Atul Auto 13% down. So even the smaller companies with smaller bases have seen weaker growth. Of course, SML Isuzu, the base is smaller, so we are looking at a 17% growth on a year-on-year basis. Correction there. Eicher Motors, of course, the commercial vehicle segment, 20% growth, of course, was expected. But look at Royal Enfield. The sales have declined 17% to come in at 62,300 odd units. The street expectation was 64,000 units to 68,000 units, and it's still short of that estimate. And in a marketplace wherein Hero is showing some recovery in volumes for the month of May, Bajaj Auto has been growing for the past few months. Clearly, for Eicher Motors, the numbers for Royal Enfield are quite weak, and given the multiple at which Eicher Motors is trading 30 times plus odd on a consensus basis, disappointing numbers would surely have an impact. And if you look at Hero MotoCorp, that is one interesting thing to watch out for. If you look at the last 6 months trend for 2019 at least, the numbers has been highest in the year. More importantly, it has been above estimates, and 6.5 lakh units. This is the number which we haven't seen for quite some time.
Why is this happening?
Probably rural markets could have done well. They have done a couple of good things in the 125cc segment. And remember, Neeraj, if you speak to Rajiv Bajaj also, if you speak to M&M, Hero MotoCorp, they still believe that the rural markets have been selectively buoyant in some pockets. If you look at Hero MotoCorp 125cc, which is their bread and butter business, there probably we have seen volumes. Of course, for the exact breakup and the exact factors, the company has to comment. But clearly, Hero MotoCorp, that number is surprising, quite positive, I would say. Street was somewhere around 6 lakh units, and, they have gone ahead and posted a number of 6.5 lakh units. So clearly, the big surprise, positive surprise from the numbers so far has been Hero MotoCorp. Of course, we are awaiting numbers from Bajaj Auto, Ashok Leyland, and, those large companies. But the numbers so far, which have come in ex-Hero MotoCorp, I would put it that way, have been slightly disappointing versus the expectations.
Okay, so the one standout number, I'm guessing by virtue of it being in the green, is Hero MotoCorp. But my question is, what happens, what are dealers saying, or rather, what are the stock dealers saying? What could happen to a Maruti, to an Eicher Motors in the session today, or over the course of the next 3 or 4 days?
Neeraj, if you look at today's trading session, there might be some slight correction. But, the thesis here is these are all FII heavy counters. Flows have been positive. So from the trade setup, if you look at it, the flows are strong. And more importantly, the companies, including Maruti, have been guiding that first half of this financial year will be flat to negative. Probably in the second half, because of pre-buying of BS6, we could see some growth. So on an average, if you are expecting zero growth in the first half, 10% growth in second half, Maruti has guided for a 5 to 8% volume growth. So obviously, most of the auto companies were expecting a muted first half. Of course, monsoon is also a factor which will determine the second half sales. But everybody is hopeful that second half will be recovery. There have been talks that government is looking to cut GST, government is looking to introduce scrappage policy. All of these factors probably are support points, but you never know how really does the market react. In the case of Page Industries, we are seeing that the P multiples are declining. That could be the case for Maruti as well as Eicher Motors if the market believes that the decline is expected to continue. But probably second half gives hope for many investors or institutional investors that elections have gotten over, decisive government has come in, situation would improve, liquidity would improve, monsoon would fill up your sales. So second half is something which the markets are eyeing at this point in time. First half doesn't matter because the companies have already guided for weaker sales.
Okay, well, let's wait and watch if the lower than expected numbers play spoil sport, or is all of this already in the price? Yatin, thanks so much for putting that into perspective. That's all that we have on Indian Open. Frankly, all that was needed has been covered. Lots more lined up on Indian Open though. We talk about markets, macros, and what should individual investors do with Jyotivedant Jaipuria of Valentis Advisors. India's economic slowdown raises many questions. We decode the factors at play with Anubhuti Sahai of Standard Chartered Bank, and Maruti Suzuki is bearing the brunt of the economic slowdown. Chairman Mr. R.C. Bhargava will join us to talk about the falling auto sales. But after this break, a full tilt towards the day's trade.